Good morning, everyone. You're watching a live market outlook for Wednesday, 14th of December 2011, prepared by Windsor Brokers. The pressure on the markets remains with the euro hitting a fresh 11 months low, accelerating its losses after comments from Federal Reserve that warned that actually wanted to put some additional support to the modestly growing U.S. economy, and this actually dampened the single currency that dipped close to 130 psychological barrier and actually remains in the free fall for now, with some significant level seen on the break at 130 towards 128.72, the low of 2011. The Federal Reserve warned yesterday that turmoil in Europe presents a big risk to the U.S. economy, leaving the door open for possible further steps to boost the growth, even though it noted a somewhat stronger labor market. The central bank has said that U.S. economy was expanding moderately despite an apparent slowing in the world economy. But while there had been some improvement in the job market, unemployment still remains elevated and housing depressed. Some investors had speculated that Fed might show more urgency about moving ahead with the new measures to help the economy. However, this didn't happen. And as immediate reaction, the U.S. stocks fell while the prices for government debt rose, and the dollar, which has been pressured by Fed's huge bond buying programs, now gained again against euro, and heading higher. That immediately pushed the gold that is already in the downtrend even lower. This we are going to see in our technical outlook in a couple of minutes. Also important today is the OPEC meeting in Vienna. That again, still we have two blocks within the OPEC price hawks that led by Iran, Venezuela, and Algeria, and from the other side we have Saudi Arabia and the Gulf countries. The OPEC's oil price hawks look set to accept a new group output target that legitimizes a big increase in supply over the last 6 months from the rival producer Saudi Arabia and its Gulf allies. A deal expected to be reached today restores some credibility to the organization of petroleum exporting countries after talks fell apart in June and left the cartel without its normal self-imposed output constraints. The leading producer, Saudi Arabia, has forced price hawks, as mentioned earlier, Venezuela, Iran, and Algeria, to recognize a large rise in Saudi supply since June. That also compensated the Libyan losses and kept the prices of crude oil unchanged near $110 per barrel. In a show of strength, the Saudi oil minister Al-Naimi announced on his arrival in Vienna that Saudi output had topped 10 million barrels daily, its highest in decades. Also, yesterday's spike on the crude oil prices was caused by rumors of Iran closing the Hormuz door to the Gulf due to their military exercise, and the oil prices shoot higher. Later on it reversed a bit, but we can see that oil is again becoming quite vulnerable to all the political events, and it reacts immediately, while gold has until now main safe haven instrument. It's losing its safe haven, let's call it rating, and is now moving along with the other high yields instruments. From today's calendar, apart from OPEC meeting that will last all day, we have the soon to come at 9:30 GMT, the jobless claims from UK that are expected to raised significantly to 16.1 thousand compared to 5.3 thousand the previous month release, and the unemployment rate is also expected higher at 8.4% versus the 8.3% previous month release. Average earnings index on 3 months from UK due at the same time is showing decrease in earnings to 2% compared to 2.3% raise previous month. From Switzerland at 10 o'clock GMT, zoo economic indicators, no forecast. The previous release showed a negative figure at minus 64.3. At the same time, Eurozone industrial production monthly release is expected to show some positive tone in the IP, as the forecast for today is growth by 0.1% compared to the again negative reading of the previous month at minus 1.9%. Across the ocean, Canada starts at 13:30 GMT, leading index monthly reading forecasted at 0.3% compared to previous month release at 0.2%, while manufacturing sales are expected to stay unchanged compared to 2.6 raise previous month. Import prices from US are due at the same time at 13:30 GMT, and the forecast for today is 1.1% growth compared to a negative figure on previous month release at minus 0.6%. And at the end at 15:30 GMT, US weekly crude oil inventories are expected to show the draw of minus of 2.2 million barrels compared to the build of 1.3 million barrels seen on the release last week. Now let's take a look on the markets and see the latest movements. We'll start with euro with the weekly chart, so just to have more clear picture of what's going on, as the euro remains in the steady downtrend from 149.38 high of 2011 posted on 1st of May. We have seen loss of neckline of the wider picture, weekly picture, the head and shoulders pattern, break below neckline at 130, around 132.25. Then the loss of critical support at 131.45, which is 2nd of October, previous low accelerated actually losses, and the temporary support was found just ahead of 130 psychological support. As we can see on the daily, the studies are quite negative, with the MACD below there, its midline and below the signal line, as well as momentum, while the RSI is now entering the oversold zone. This might signal some corrective action, however nothing significant unless a break above 135 is seen on the daily chart. That would provide temporary relief and signal bottoming at this area. On the downside, further extension lower is looking for a test of 128.72, the low of 2011 posted on 9th of January, so the beginning of the year. And also we see that the pair has broke below 61.8% Fibonacci retracement of the longer term uptrend from 118.75 low of 2010 up to 149.38 high of 2011. Below 128.72 we will see, this is in the short to medium term, unless the scenario of the latest weakness of the pair continues at this pace. The next level comes around 126.00 with also Fibonacci 76.4 level at this point. Now on the shorter term outlook, the pair is attempting to bottom at this level as oversold conditions see scope for a potential bounce higher. However, for now, the fresh weakness is keeping the upside out of reach with only 130.50 seen so far on the bounce from 130.08 low seen late last night. And the likely scenario would be further extension lower. However, the corrective action on the upside faces 131 as initial resistance, and then 131.50, while only firm break above 132 and 132.35. Yesterday's high would provide a temporary relief for euro dollar. The main trend remains firmly bearish. Cable again, similar situation, acceleration of losses after losing the consolidation channel support at 155.60, 155.36, breaking below 155.25 and 155.00 supports, and extending losses so far to 154.49 with immediate focus at 154.22. This is the critical support. We will show it on the daily chart. Low of 25th of November. Also significant is the break below the short-term bear channel from 157.77 high, 57.68 high, pardon, that extended so far to 154.49. Corrective action now on oversold 1 and 4 hour studies. Faces initial barrier at 155, that is giving way now. Then we have 155.36, 155.60, while only lift above firm break above 156 would delay immediate bears and look for a stronger correction. The upside on the broader picture remains capped firmly above 157 zone, 157.77, 157.68. with loss of 154.22 low to confirm the double top pattern here, and open way for a fresh leg lower. On the downside, the next critical levels are at 153.28 low of 23rd of November, and the most significant level is 152.71 low of 6th of October 2011. Better seen on the weekly chart, where is also the range, recent range floor, as we can see that the pair was in a way limited at the downside at levels around 153, 152.70. So break here is to confirm an end of this wide range, and the focus levels on the downside with the Fibonacci 61.8% at 151.90 of the longer term uptrend from 142.30 low of 2010 up to 167.37 high of 2011, posted on 1st of May 2011. Dollar yen maintains positive tone after yesterday's dip, found support at 77.66, just ahead of our strong support at 77.50, which also marks 50% of Fibonacci retracement of the post-intervention rally in October from 76.56 record low to 79.52 peak post-intervention, and this is acting as a strong support, and while holding above this level keeps the short-term focus higher. Immediate support now comes at 77.90-80 zone, where also stands the short-term trend line from 77.12 low of 8th of December. We need to see clearance of 78 barrier, clear break of 78.10 to refocus the previous high of 29th of November posted at 78.27, and likely to resume the medium-term positive structure from 75.56 with clearance of 78.27 to open 78.40-50 zone, and then 79 as the next significant level ahead of 79.52, the peak of 31st of October. As mentioned earlier on the downside, 77.80-90 is the first support, Then comes 77.63 ahead of 77.50. The critical level here, break of which would weaken the short-term tone and the focus levels on the downside with the 77.28, 77.12 to come next ahead of psychological support at 77.00. The dollar Swiss also is a strong uptrend as the greenback is now in full speed. Break above the previous congestion just under 93 and the previous high at 93.28. Accelerated losses initially yesterday to 93.86. Followed by mild correction down to 93.40. If you remember yesterday, we mentioned that 93.28, 50.28 should offer good support and should contain the dips, while only loss of with possible extension down to 93 not ruled out, but only break below 93 to weaken the structure. As we can see, our studies were correct. 93.40 offered good support ahead of a strong rally that accelerated gains through 93.80, which is Fibonacci 50% retracement of the broader downtrend from 117.30 high of 2010 down to 70.67 low of 2011. Also historical low of dollar Swiss. That gives a positive signal for further rally and opens 95 level for test. 94.76 was seen so far. 95 is the next psychological resistance and the figure resistance ahead of 95.46, which comes next on the break on 95, and this is 5th of November 2010 low. The studies are positive but overstretched, and this might signal some corrective action before bulls reassert for a fresh rally higher, with initial support coming at 94.00 and 93.40 expected to contain, along with the 20 days simple moving average on the 4-hour chart. Loss of 93.40 and 93 would put temporarily aside the immediate bulls and look for deeper correction. However, at this point, I would say that the bulls are quite firm, and unless something happens from the fundamental side, the strength of the dollar is not to be questioned now. Gold extends its losses, accelerating on the yesterday's fresh strength of US dollar. As we can see, the initial trendline support was broken, and actually the yellow metal is now testing the 200 days moving average of the broader downtrend, the 200 days moving average on the daily chart, currently at 1618 with the 1622 seen so far. Ahead of also strong support at 1600 zone. The studies are negative. As we can see, the daily MACD is now breaking below the midline, and this signals further extension lower, especially in case of break of 200 days moving average that might in the short term refocus levels below 1600, with 1582 coming first, and then the critical support at 1532 low of 26th of September 2011. The short-term outlook is studies are quite overstretched, and they oversold the RSI on 4 and 1 hour already bouncing. 1 hour is already bouncing higher. Suggests some corrective action. Initial resistance at 1650 and then 1677, where also stands the 20 days moving average. Also, we have at this zone 1666 previous low, and 1672. So basically 1660, 1670, 80 zone is offering quite strong resistance, and in order to resume the recent downtrend, this area should cap the corrective attempts. Crude oil is easing lower after yesterday's spike. This is what I was talking about on yesterday's rumors of Iran closing the Hormuz. However, the current outlook is regaining momentum on the 4-hour chart, and the studies are turning into positive territory, keeping away recent low at 97.36 and attempting to build a higher base at this point. A clearance of a brief break above 100, actually yesterday's extension to 101.22 keeps the positive tone in play. However, today's close above $100 would be quite supportive for the crude oil, and would look for extension higher to series of highs 101.69, 101.92, and then next strong barrier at 102.42, break of which, and 103.35 is required to resume the broader uptrend from a 74.94 low. Actually, this is currently the sort of consolidation, and as long as 200 days moving average currently at around 96 zone holds the downside, the focus remains firmly at the upside, and possible extension up to 114.80 high of 2011 is not ruled out at this point. Loss of higher platform at 97.36 would bring focus down to 200 days simple moving average 95 and 91 currently, and then 95 zone as a strong support. At this point, the bulls are on the daily chart still in play, but sort of weakening is seen, and this would be confirmed in case of failure to regain 102.42 initial resistance.